Welcome back. So, the stock market is absolutely on fire, right? It feels like we're hitting a new record every other day. But if you look just a little closer, some of the biggest, most popular stocks are, well, they're stumbling. Today, we're going to untangle these mixed signals and figure out what is really going on. Okay, let's just start with this number, 38. That's how many times the S&P 500 has smashed its own record and hit a new high just this year alone. I mean, that number just screams that the market is healthy and it's making a lot of people feel pretty optimistic. But here's the twist. While the rest of the market is popping champagne, some of Wall Street's absolute favorites, we're talking about companies like Tesla and Netflix, are suddenly getting downgraded by analysts, and their stocks are actually falling. It just doesn't add up. So what's the real story here? Right, so this brings us to the big mystery we're unpacking today. In a market that looks this good on the surface, why are these huge, influential companies suddenly hitting a wall? You know, it's a question that really cuts through all the noise. We're in what a lot of people are calling a Goldilocks economy. Not too hot, not too cold, just right. It should be the perfect environment for stocks to thrive. So why are these specific tech giants having such a tough time? Let's dig into the immediate causes. Okay, so the most direct reasons are pretty straightforward. Wall Street analysts are starting to get nervous. They're looking at these sky-high prices, these massive price-to-earnings ratios, which is basically just how much you're paying for a dollar of the company's profit. And they're starting to ask, wait a second, are these prices getting a little crazy? So this isn't some random market blip. It's a very targeted, very deliberate rethink by the expert. But, this is just one piece of a much larger puzzle. To really get what's happening, we need to look at the good news that's supposedly holding up the whole market and find out why some people are actually pretty skeptical about it. So on paper, things look incredible. The official GDP growth number for the third quarter came in at a blistering 4.3%. That suggests the economy is just humming along with some serious power. Now, check this out. This slide really tells a tale of two completely different economies. On the left, you've got that official 4.3% growth. But on the right, you have economist David Rosenberg, who's saying, hold on a minute. He argues that if you strip out temporary things like companies just building up their inventory, the real growth is actually, well, it's just 0.8%. See, building up inventory makes GDP look good now. But if people don't actually buy all that stuff later, you've just borrowed sales from the future. And that tells a totally different story. So this huge difference in the data really shines a light on some major risks that the market seems to be, happily ignoring right now. Let's break down the three biggest dangers lurking just beneath the surface. First up, valuation risk. Plain and simple, the market is priced for absolute perfection, and that leaves zero room for any mistakes. Second, can we even trust the data? I mean, if that big GDP number is shaky, what other numbers are we relying on that might be misleading? And third, we've got the Fed. They have flat out warned that things like tariffs could seriously damage the economy and drive up unemployment. That's a huge risk the market just seems to be shrugging off. Okay, so with this messy, complicated picture, what's an investor supposed to do? Well, it's definitely not about panicking. The real key here is to shift your mindset from a gut reaction to a deliberate strategy. And that leads us perfectly to this idea of System 2 thinking. So think of it this way. System 1 is that fast, emotional gut reaction you have. But System 2, that's the slow, logical, analytical part of your brain that actually looks at the data. In a market like the one we're in right now, you absolutely have to engage System 2. So here's what that looks like in the real world. This is a practical playbook. System 2 in action means you're actually looking at the valuations in your portfolio, not just how much it's gone up. It means making sure you're not way too heavily invested in just tech. It means holding a bit of cash so you're ready when opportunities pop up. And it's about focusing on solid, high-quality companies instead of just chasing the latest speculative story. And this really brings us to a powerful way to think about all of this. Don't just see the uncertainty and the volatility as a threat. Because when the market gets scared, it often panics and throws out the good companies right along with the bad ones. And that can be an incredible opportunity to buy a great business at a fair price. So what's the big takeaway from all this? It's not about trying to predict the future. The real edge, the real advantage, comes from understanding all these different layers of what's happening in the market right now. That's how you stay ahead of the game. Look, the headlines are always going to give you the simple story. But your real advantage, that comes from understanding the why behind those headlines. why that GDP number might not be what it seems, or why some stocks are getting hit while others aren't. This kind of deep, consistent analysis is what separates someone who just reacts to the market from someone who has a real strategy. And that's really the final question we want to leave you with today. Are you actually prepared for whatever the market decides to do next? By keeping up with these explainers and digging deeper than just the headlines, you're giving yourself the tools you need to answer that question with a confident yes. Thanks for watching.